Thanks for joining us for the executive series today. I'm speaking with Sunny Bangia, who is a portfolio manager at Antipodes Investment Management. Sunny, it's great to talk to you again.
Thank you.
It's been a while since we've last spoken. There has been a lot go on in terms of the broader market picture over the course of the last 6 months in particular, a lot of volatility. What is the methodology that you're applying to this setup at Antipodes at the moment?
Yeah, absolutely. Look, we're a capital preservation focused fund manager. We're looking to buy global equities around the world. We're looking to define interesting ideas, get equity market exposure with significant lower levels of volatility. So our approach is long-short. And we apply our stock picking skills on the long side as we do on the short side to find these opportunities. So it has been a volatile period. Through cycles, we've done quite a good job, and through periods of drawdown, our performance has held up significantly better than the market.
I suppose a long-short fund is precisely what you need when you've seen the market at record highs recently, but it's retreated from those levels very aggressively.
That's absolutely right, and also why you should also have an active fund. You've had this period for the last several years where policymakers, particularly from the central banks, have been very proactive in protecting markets. Every dose of monetary stimulus has kind of had a less of an impact on the real economy, and it's ultimately with the real economy that matters. It's a real economy that votes, and we're getting a shift now towards more of a fiscal stance, and I think that kind of regime shift is well suited to an active manager such as ours, someone that's actually thinking about both longs and shorts in this regime change.
Okay, so let's dig a little deeper into this. We've got a construct where global rates are coming down, there's moderating growth, and you've got extreme volatility in the equity markets. How do you pick the eyes out of markets in that sort of situation?
Yeah, look, I think for us, it's still about buying the right companies at the right price and understanding which companies are benefiting from the various regime changes we're seeing today. So the move towards e-commerce that's happening globally, perhaps most pronounced in China. We see great opportunities there, both in that space with companies like Alibaba, and understanding how the e-commerce landscape has evolved in China, seeing that there are businesses in the Western markets such as Facebook that are very well positioned to capture those trends. Now, these are long duration opportunities that we think are coming to us at a reasonable price today, but also then understanding that the push towards populism and nationalism aren't going away. And potentially we may be in a regime where we see more fiscal stimulus. So we've already seen that out of some Asian economies such as in China, India, South Korea that have implemented that kind of stimulus. And businesses exposed to the cyclical parts of those markets can be quite attractive given how low valuations have become and how worried everyone's become about growth.
When you think about your portfolio, are there any particular names that stand out in terms of how pleased you are in the way that they've performed over the course of recent times?
Yeah, look, we've been very positive on the Chinese consumer. So we're playing two Chinese consumers. We're playing the upper end. We're talking about the 40 million, 50 million people that have an income per annum of over $35,000, $40,000. And those businesses exposed to that particular theme have been some of our high-end spirits companies, such as Walangi, Ping An Insurance. That's been great parts of the portfolio. And then we've actually been exposed to the low-end consumer in China. So we're talking about 500 to 600 million people now, with an average income of closer to $4,000 to $5,000. So there's quite a bit of disparity there. And businesses exposed to that bottom end have been, Alibaba is expanding into that region. Yum China with the KFC brand is expanding into those regions. And we think that's actually a very long thematic that we can play in those businesses for a number of years, and both companies on the upper end and the lower end are actually quite reasonably priced given all the concerns around trade, and the businesses are actually very domestically exposed, so they're not very impacted by trade wars on the surface.
So that's a good point that you make, that notwithstanding some of the risks that might currently be impacting themselves on the Chinese economy, you've still got longer run thematics that are impossible to ignore.
Oh, that's absolutely right. It's very hard to ignore the rise of the Chinese consumer. It's very hard to ignore that as you become wealthier, you desire more different type of products. You desire to travel, to drink higher end alcohol, or to just move your behavior towards e-commerce,
Yep.
buying life insurance. These kind of very natural human tendencies don't go away. And that's kind of the opportunity we see today over the next several years in China. But having learned from what's happened in China, we can apply a template to how e-commerce can evolve in Western markets. And that's what we like Facebook. We think Facebook, which is today a very dominant advertising platform, has the full potential to evolve itself in a much more stronger platform, an all-encompassing services platform with e-commerce and other services.
So the regulatory situation where Facebook is concerned, is that a liability, or is it something that they can work with and become a better organisation in the bigger picture?
Yeah, so at Antipodes, we think about our businesses in terms of what kind of resilience, what kind of positive factors are working on them, how many ways they can win. Obviously, regulatory is a risk for big tech generally, and we have assessed the risks company by company, and we look at companies like Google that might sit at the upper end of that risk spectrum, and Facebook somewhere in the middle. Having said that, what we are saying about Facebook is, given the risks around regulatory are well understood, are well known, it's why the company has come to us at a more attractive valuation. We're monitoring them, so if anything was to get very ugly, we will be reassessing. But that's notwithstanding the longer term thematic and the dominant position that Facebook is, and particularly with its portfolio of assets such as Instagram, WhatsApp, and how they will be monetized over the next several years.
Sonny, one of the themes with listed investment companies has been the fact that they have been trading at a discount to their net asset value, and Antipodes has found itself in that position as well. What sort of measures are you taking to address that?
Yeah, look, we have been out there, management have been out there buying back stock, so that's a strong commitment from the managers of the product that we believe in our product. We're getting a high quality collection of companies at a discount, so that's an excellent opportunity from our point of view. We've initiated a buyback because we want to send out a signal to the market that we think that this is quite undervalued, and we want to be buying back shares at this undervaluation. We're also looking out to highlight the APL product in the market and communicating with a broad range of investors to drive incremental buys. So we see ourselves as a very important long-short manager in the portfolio of many clients. Doing something that's very differentiated from many other long-only or managers in the global equity space, and it's out there trying to just drive more incremental demand into the product.
Sonny, it's always good talking to you. Thanks for your time.
Thank you, Tom.
And thanks for joining us for the Executive Series.